SoFi Technologies, trading under the ticker SOFI, is currently at $27.375, down 2.16% in today's trading session. While many investors are focused on the day-to-day fluctuations, what's far more compelling is the underlying tension between the popular narrative surrounding SoFi and the often overlooked realities of its operational mechanics and strategic positioning. The common perception is that SoFi is a disruptive fintech company, a one-stop shop for the younger generation's financial needs, and a stock that has been on a remarkable run. While this is true to an extent, it's a surface-level understanding that misses the more intricate and arguably more important details that will ultimately determine its long-term trajectory. Many who are bullish on SoFi point to its impressive member growth and its expansion into a wide array of financial products. They see a company that is successfully capturing a demographic that is disillusioned with traditional banking. This is the expectation. The reality, however, is a much more complex picture, one that involves a delicate balancing act between rapid growth, profitability, and navigating an increasingly competitive and complex regulatory landscape. The exuberance of the market often overshadows the inherent risks and the nuances of SoFi's business model. A deeper analysis reveals that while the company's growth is undeniable, the path to sustained, profitable growth is not as straightforward as the current stock price might suggest. Let's first address the recent market activity. The stock has seen significant volatility, which is to be expected for a company in a high-growth phase. Trading volumes have been consistently high, indicating a strong interest from both retail and institutional investors. This high level of engagement is a double-edged sword. On one hand, it provides liquidity and can drive the stock price higher. On the other hand, it also makes the stock susceptible to sharp swings based on market sentiment and news flow. We've seen this play out in recent weeks, with the stock reacting strongly to both positive and negative catalysts. For example, the announcement of a new partnership or a better-than-expected earnings report can send the stock soaring, while concerns about the broader economy or a regulatory crackdown on the fintech industry can have the opposite effect. This is where a discerning investor needs to look beyond the headlines and understand the fundamental drivers of the business. Many investors using platforms like Robinhood or Fidelity for their self-investing activities are drawn to the allure of high-growth stocks like SoFi, often without fully appreciating the underlying complexities. While these platforms, including SoFi's own SoFi Invest, offer incredible access to the markets, they also necessitate a deeper understanding of the companies one is investing in. A significant part of the SoFi story revolves around its transition from a student loan refinancing company to a full-fledged digital bank. This has been a key driver of its growth and a central part of its appeal to investors. The acquisition of a national bank charter was a critical step in this process, allowing SoFi to hold deposits and offer a wider range of banking services. This has not only expanded its revenue streams, but has also provided it with a lower cost of funding for its lending operations. However, this transition also comes with increased regulatory scrutiny. As a bank, SoFi is now subject to the same rules and regulations as traditional financial institutions. This means higher compliance costs and a more conservative approach to risk management. The market often underestimates the challenges of navigating this regulatory environment, especially for a company that is still in a high-growth phase. The recent partnership with Lightspark to power blockchain-enabled international money transfers is an example of SoFi's commitment to innovation, but it also highlights the regulatory tightrope the company must walk. The introduction of new products and services, while exciting for investors, also introduces new layers of complexity and risk. Another area where expectation and reality diverge is in the company's profitability. While SoFi has shown impressive revenue growth, its path to consistent profitability has been a key focus for investors and analysts. The company has made significant strides in this area, but it's important to remember that it is still investing heavily in growth. This means that profitability can be lumpy and may not always meet the market's expectations. The company's recent earnings reports have been a mixed bag in this regard. While top-line growth has been strong, the bottom line has been more volatile. This is not necessarily a red flag, but it is a reminder that SoFi is still a work in progress. Investors who are looking for a stable, dividend-paying stock may want to look elsewhere. However, for those with a higher risk tolerance and a long-term perspective, the potential for significant returns is certainly there. It's a classic growth versus value proposition, and where an investor falls on that spectrum will largely determine their view of SoFi stock. For those who are comfortable with the inherent volatility of a high-growth company, SoFi presents a compelling opportunity to get in on the ground floor of a potential financial services powerhouse. Many investors are turning to services like Schwab Intelligent Portfolios or Fidelity's wealth management services to help navigate these complex decisions. But for the self-directed investor, a thorough understanding of the company's financials is paramount. Now, for those who may be less familiar with the intricacies of SoFi's business model, let's break down its core operations. SoFi operates through three main segments: lending, technology platform, and financial services. The lending segment is its traditional business, offering student loan refinancing, personal loans, and home loans. This has been its company's bread and butter for many years and continues to be a significant contributor to its revenue. The technology platform segment, which includes Galileo and Technisys, provides the infrastructure for other companies to offer their own financial products. This is a high-growth area for SoFi and a key part of its long-term strategy. By providing the back-end technology for other fintech companies, SoFi is essentially becoming a pick-and-shovel play on the broader fintech industry. This is a savvy move, as it allows the company to benefit from the growth of the industry as a whole without having to bear all of the risks of being a direct-to-consumer business. The financial services segment is where SoFi is building out its digital bank, offering products like SoFi Money, a cash management account, SoFi Invest, an investment platform, and SoFi Credit Card. This is the segment that has been getting the most attention from investors, as it represents the future of the company. The goal is to create a seamless, all-in-one financial ecosystem that can meet all of a customer's financial needs. This is an ambitious goal, but if SoFi can execute on its vision, the potential rewards are enormous. Looking ahead, there are several key catalysts and risks that investors should be aware of. On the catalyst side, continued growth in its member base and the successful cross-selling of its various products will be crucial. The more products a member uses, the more valuable they become to the company. The expansion of its technology platform and the signing of new enterprise clients will also be key drivers of growth. The recent announcement of the Agentic AI ETF is a step in this direction, showcasing SoFi's commitment to offering innovative investment products. On the risk side, the macroeconomic environment will continue to be a major factor. A recession or a significant increase in interest rates could have a negative impact on SoFi's lending business. Regulatory risk is also a major concern, as any new rules or regulations could impact the company's ability to operate and innovate. Competition is another key risk, as the fintech space is becoming increasingly crowded. SoFi will need to continue to innovate and differentiate itself from its competitors in order to maintain its growth trajectory. The performance of other fintech stocks, such as those available on interactive brokers or other investment sites, will also be a bellwether for the industry as a whole. Do you think the increasing competition in the fintech space will be a major headwind for SoFi's growth? Comment below with your thoughts. In the final analysis, SoFi is a company with a tremendous amount of potential, but it is also a company that faces a number of significant challenges. The expectation of a smooth and linear path to dominance in the financial services industry is likely to be met with the reality of a more volatile and unpredictable journey. The company's success will ultimately depend on its ability to execute on its vision, navigate the complex regulatory landscape, and fend off the competition. For investors, this means that a long-term perspective is essential. Trying to time the market or trade the day-to-day fluctuations is a fool's errand. Instead, a focus on the underlying fundamentals of the business and a willingness to ride out the inevitable ups and downs will be the key to success. The narrative of SoFi as the future of finance is a powerful one, but it is the reality of its execution that will ultimately determine its fate. The stock is not for the faint of heart, but for those who are willing to do their homework and take a long-term view. The potential rewards could be substantial. It's the contrast between the simple bullish narrative and the complex, nuanced reality that makes SoFi such a fascinating and compelling company to watch. It's a story that is still being written, and the next few years will be critical in determining whether the company can live up to the high expectations that have been set for it.